This inflation that's been going on, it's not 10 years old, it's not 20 years old, it's not even 50 years old. It is about 90 years old. And I'm counting back from 1933. Why 1933? Because that's when the dollar gold exchange rate was fixed at 35. That's when FDR, Franklin Delano Roosevelt, changed it, or whoever was advising him, probably wasn't him, changed it from 21 to 35. And at that point, that deflation from $21 an ounce to $35 an ounce was enough to get the price system back into whack, I would say, and keep things going. But since then, the money printing has been constant, and they tried to lie about a gold dollar exchange rate of $35 until 1971. And then in 1971, they stopped lying about it. They stopped lying and saying that a gold ounce was exchangeable for $35 because it wasn't. But this inflation has been going on since the $35 change. So that's about 90 years. But in terms of can it go on for another 10 years? I don't think so. I mean, I remember as a kid in the 90s, I didn't hear about everybody being in debt all the time. And there were some struggling people, but, I lived in a, middle class, upper middle class area where people generally had savings and people were upwardly mobile and, things were generally high standard of living. But I remember it changed around 2006, 2007. People were going into debt to buy houses, and then they lost. Debts are still overhanging from there. People everywhere are in debt. I don't know anybody besides rich people, who are not in some kind of major net debt.
Rafi Farber suggests that significant turning points often lead to implosions. He predicts a prolonged period of decline, possibly spanning months or even a year. Farber points out the extensive turmoil within the monetary system, noting that unexpected events could trigger unforeseen consequences. Based on historical patterns, Farber expects a gradual erosion of the dollar's purchasing power. He emphasizes that this decline will affect the real value of goods and services. Farber contends that many recognize the unsustainability of the current system, characterized by perpetual debt accumulation, which goes against the natural balance of things. Rafi Farber explained that the current monetary system is flawed. It doesn't balance, but instead continuously accumulates. He asserts that this inherent instability is widely recognized, and there will come a point when the rapid depreciation of the dollar's purchasing power becomes unmistakable. When this occurs, the collapse could happen rapidly, possibly within weeks or even days, akin to historical examples such as the hyperinflation witnessed in Weimar Germany in 1923 and in Israel in 1984. Farber emphasizes that previous hyperinflations occurred in isolated currencies that had a stable index currency to revert to. However, the unique aspect now is that the index currency itself, the dollar, is at risk. Farber speculates on the potential outcomes, either a return to a gold standard or the disintegration of the entire monetary system, leading to the emergence of private currencies. He acknowledges that while private currencies might offer long-term benefits, the transition would likely be chaotic in the short term. Drawing parallels to the hyperinflation in Weimar Germany, Farber notes that the acceleration of inflation around mid-1923 lasted for approximately 5 to 6 months. He highlights the difference in today's context, where modern payment systems facilitate instantaneous transactions, potentially hastening any monetary collapse.
Bitcoin, Apple Pay, however you want to pay. Bitcoin is just another form of dollars, in my opinion. But you can get rid of dollars in an instant. Like that, you can get rid of everything. Spend it all in a second. We've never seen a hyperinflation in this kind of technological environment before of a base currency like the dollar. So it could be, food prices double in a month and then they double again the next month. And then, a few days after that, just bam, nothing. I don't know because we've never seen this before. We've seen qualitatively the same thing. We've never seen quantitatively this much of it in the sort of technological environment of money transfer that we have today. I don't know exactly, but protect yourself now before any of this happens. The only reason the dollar has any value is because it can still be exchanged for some amount of gold. Only if a few people do it. If everybody does it, gold would be something like $40,000 an ounce. I come to that calculation based on the Fed's balance sheet divided by the amount of gold in Fort Knox that's backing the balance sheet. So if you go back to the Great Depression and the economic damage that was caused, or no, not that was caused, that was revealed by gold moving from 21 to 35, that's about 60%. Imagine the incredible depression that would result from gold moving to 30,000 in a few weeks. I mean, God, I don't even want to think about it. I don't think we should even think of it this way. don't even think of it that way. It's not really the gold price increasing. It's the dollar collapsing. It's the dollar losing its purchasing power. If the exchange rate, the monetary exchange rate between gold and the dollar were suddenly moved to 5,000, then what do you think is going to happen? What's going to happen is everyone's going to call in for their gold immediately. Then it's not going to stop at 5,000. Once you get to 5,000, you're going to get to the real monetary exchange rate, assuming there is one, assuming there is gold at Fort Knox. It's not going to stop at 5,000. That's the danger. That's what we're talking about. I mean, at some point, it's not going to be an orderly decline in the purchasing power of the dollar. It's going to go from, let's say, 2,000, and then the next day 3,000. I don't know what the numbers are going to be, but if you look at commodities priced in gold under that scenario, commodities will be pretty cheap in terms of the gold price, because that's the real money. That's what gives the dollar its purchasing power, the gold that is behind it. It's not behind it at a fixed rate, but it is still behind it because you can still exchange for that gold. So once we get to that point, 4,000, 5,000, it's going to be the free market pushing the dollar to its monetary parity at whatever the balance sheet of the Fed is divided by the amount of gold in Fort Knox. Yeah, so once you get to 5,000, you're going to get to the free market 100% back parity very quickly.
Farber points out a critical misunderstanding prevalent among the majority, even those drawn to Bitcoin, the true nature of money. When we exchange currency for goods or services, we're essentially trading gold, though it's not immediately apparent. Big financial institutions, despite dealing extensively in gold, don't view it as money but rather as a speculative asset or a store of value. Money serves multiple functions. It's a store of value, a unit of account, among others. Gold fulfills these criteria, hence its classification as money. When purchasing something with money, whether actual gold or its substitutes, we're essentially transacting with gold. The current price of gold in dollars reflects its industrial usage rather than its monetary value. However, in times of widespread need for a reliable medium of exchange, gold emerges as the primary form of money, elevating its price in paper currency to around $30. Thus, Farber simplifies this understanding by harking back to the origins of money, underscoring gold's fundamental role in facilitating economic exchange. Farber highlights the inherent predictability in our daily lives, where we wake up with a clear understanding of our financial needs and obligations. This awareness stems from a continuous chain of past experiences, where each day's activities inform the next. It's a natural progression, rooted in individual decisions and market dynamics, rather than arbitrary government decrees. Attempting to centrally dictate prices or control an entire currency system is doomed to fail. Market forces, driven by supply and demand dynamics, inherently shape the value of goods and services. This coordination emerges organically as individuals assess their resources, needs, and spending capacities. Farber argues that any sustainable monetary system must be rooted in historical precedent and market realities. The origins of money lie in the simple act of bartering, where individuals exchanged goods based on their mutual utility. Gold and silver emerged as preferred mediums of exchange due to their intrinsic value and widespread acceptance, not due to any central planning. In essence, every paper currency traces its lineage back to these fundamental principles, underlining the importance of market-driven mechanisms in determining the value and stability of a monetary system.